Well, even with some of that pressure that we're seeing in tech, let's check in on shares of Meta. Friday, closing at a 10-month high. It has sparked a wave of upgrades, including our next guest, David Hedger, that 10 days ago upgraded the stock. He's senior equity analyst at Edward Jones. David, when you look at a stock that has already performed so well, not just so far in 2023, but really since announcing that big found religion moment when it comes to cost cutting. Where do you see more upside for shares of Meta?
Well, certainly the shares have performed very well, and I think that reflects an improving outlook for earnings for the company. And first, from a revenue point of view, we see the potential for revenue to stabilize as we move through the year. Certainly, the company has endured what we would call a online advertising recession, where companies have pulled back on their spending on online advertising, and certainly Meta suffered from that. But we think that the worst of that may be behind them. The company also has opportunity to ramp revenue from the Reels feature as advertising starting to improve there. Also, click-to-message ads have been ramping very nicely. So from a revenue point of view, we see potential for at least stabilization, if not some improvement as we move through the year. Finally, also the changes that Apple made to their operating system that enabled users to opt out of ad targeting also had a negative impact on the Meta, and the worst of that impact should be behind them as well. And then from an expense point of view, the company is taking pretty dramatic actions to cut back what now looks to be at the midpoint about $8 billion of expenses that came out of its prior guidance for 2023. So that should certainly also help the earnings picture with revenue stabilizing to potentially starting to improve later in the year.
Now, I don't think you do a price target, but when you're talking about a stock that has doubled from the lows in November, how much more upside do you see? And I'll caveat that we're still a long way away from the all-time high that was reached in 2021.
Right. Well, certainly, stocks had a very challenging 2022, and you could certainly argue that perhaps the market treated it unfairly with how low the stock dropped, especially after it reported its third quarter earnings, and investors were disappointed with the company's expense outlook. And certainly, we had concerns at that time with it seemed as though the company was perhaps a little tone deaf to the situation of the ad market, and continue to push forward with heavy spending on its metaverse initiative. But since that time, the company certainly seems to be listening to investors and perhaps gaining religion on the expenses and trying to pull some of that investment back to more match the reality of the current ad spending environment.
Is there a catalyst on the horizon? Because a lot of these points on sort of costs and the stickiness of its base, I think you could argue, captured in the most recent rally. Do you see anything coming down the pipe that could be a catalyst for even further upside?
Well, one piece of news that continues to swirl in the online ad market is what the future of TikTok will be, which is a significant competitor to some of Meta's platforms, whether it be Facebook or Instagram. And so there's been talk of a possible ban of TikTok in the U.S. We're not convinced that necessarily will be successful, or certainly not assuming that comes to fruition. But I think it does raise some additional concerns amongst advertisers, just in terms of there's uncertainty around that platform, and may cause some hesitation in terms of incremental spending on that platform versus other online platforms, whether that be Meta or others in the space.
David, thank you so much for joining us with that perspective. We appreciate it. That's David Hedger, senior equity analyst at Edward Jones.
It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. Of course, the federal budget isn't the only topic that we're covering today. We're also tracking the ongoing fallout from the banking crisis in the United States and Europe. For more insights, we're back with Ryan Elliott of Seidel Asset Management. Thanks again for being with us today. You noted in a note to us that this crisis is really shining a spotlight on asset allocation, and that this isn't just a concern for the big banks, this is also a concern for private clients. Can you expand on that?
Yeah, so right now what's happening in the U.S. is a lot of deposit makers are looking at bank balance sheets, and they're looking at the risk management departments and saying, if I deposit money with this bank, what are they actually going out and investing in? What happened with Silicon Valley Bank is they took a bunch of deposits during the pandemic, they bought 10-year treasuries, for money that was needed to be liquid over the next 3 or 4 years. And so when that sort of time frame comes up and those companies need the funds, the money's not there. The money's locked into a 10-year sort of vehicle. And that's fine in rising markets. When the markets are continuing to increase, bond yields are staying relatively stable, that's okay, because your asset that you purchased to offset your liability in the future, they're one for one. The problem is when we had a interest rate increase like we had, volatility in the stock market like we're having, you can quickly get into a liquidity mismatch scenario. What's sort of happened over the past 10 years, and especially for investors and private clients, is if you were a 70-30 or a 60-40 asset allocation client, that 30% fixed income or 40% fixed income was invested in low-yielding fixed income. And that, for some investment advisors and managers and retail investors, was not enough. And so they wanted more yield out of that portion of their portfolio. So they've taken that fixed income exposure up the risk curve, whether that's going from government bonds to corporate bonds, or corporate bonds to high yield, or high yield to sort of private credit. We've seen a bit of a transition to higher riskier sort of assets within that fixed income bucket. And those could be appropriate for some private clients and retail investors. But when things go bad and you have a correlation on some of those assets, or a higher correlation to equity on some of those assets, if that was a true liquidity bucket, if that was supposed to be when things go wrong, that's our pool of assets to draw on, that's not happening anymore. And so I think it's prudent for individual investors, asset managers alike, to really review their exposures, and is that falling into the correct bucket? Is it doing what we expected it to do? And if not, make those changes now. We're looking at our client portfolios right now, and if a client comes to us and says that we'd like some cash in 6 to 12 months, we're okay raising that right now and putting it into cash. We can earn a good yield on cash, and I think it's just prudent risk management. We want to make sure that if they want to spend $10 in 6 months from now, 12 months from now, that $10 is $10 or $10.02. We don't want that $10 going to $9 and them having to sell something else in their portfolio to provide that liquidity.
A lot of experts have said that Canada is relatively insulated from this banking crisis. Our banks are relatively conservative, pretty well managed, well diversified. But this isn't a moment to be smug. Do you see any areas in our banking system that you see as some pain points, some possible vulnerabilities?
So, of course, I think everyone will point to the real estate market and our over-leveraged real estate market. So that'll be one thing to watch. Market has sort of rebounded this year with the thinking that rates will be cut, mortgage rates will go back down, and speculative fuel is back. So we'll be watching that a little bit, because if that starts to show cracks, amortizations are through the roof right now. So we'll be watching sort of that closely. There's also commercial real estate, which I think is becoming a bit more of an issue and on the radar for a lot of people, specifically in the U.S. right now. We do have commercial real estate exposure here too in Canada, and so we'll be watching how that all plays out and what sort of office spaces in the downtown areas, in the densely populated areas, start to look like in a post-COVID world.
Get a lot on your plate, lots to watch. All right, thank you so much, Ryan. We really appreciate you coming in today.
Well, athletic and leisure wear Lululemon is seeing its pre-market shares soar as high as 16%. That's as it laid out a full-year outlook that surpassed street expectations. Here's BNN Bloomberg's Kamuta Ramanathan with more. Hi, Kamuta.
Hi there. Good morning to you, Paul. I mean, this is one of those retailers that seems to be going from strength to strength, and that is basically what the takeaway is from analyst commentary today. Let's take a look at some of the highlights from the Q4 period. What's really enticing the market right now, ahead of the formal trading day beginning, is all about that full year outlook surpassing expectations. But first, let's look at Q4. You can see adjusted earnings per share a whopping $4.40 per share US, handily beating market expectations there. As you can see, about $4.26. Now, revenue sales overall, 30% increase year over year, again, slightly above the street expectations. But what's really exciting is that their 2024 forecast really focuses on sales being in that 9.3 to 9.4 billion range. Now, one thing that was a pause for caution for a bit of the street was about those increasing inventories for the business. In fact, it was something that the chief financial officer wanted to address during the earnings call, saying that, just wanting to reduce those concerns overall and saying that we expect significant margin expansion driven by lower air freight costs in the successive quarters that are coming. So as a result, our gross margins are going to increase. The question is, Paul, we've been here before. Many analysts, many in the retail sector thought that the supply chain chaos that was brought on by the pandemic would initially be 6 months. Then it was 1 year. Then it was 2 years. Now we're going into several years, depending on the sector that you're in. So according to Lulu, there is enough runway for growth to obscure some of those costs, as well as those air freight concerns in particular. The question is, can they really continue to grow full steam ahead?
What street reaction are we seeing so far?
Just to give you a sense of sort of the jubilance in the marketplace, I mean, talk about being an outlier. Just over the last 24 hours, TD Cowen, Bank of America, Credit Suisse, as well as Stifel have all increased their price targets for the business. Neil Saunders over at Global Data had some really positive things to say about the results, saying that the business has succeeded in moving outside of its core workout gear. Remember, this is a business that had that 5-year plan set to end in 2026. They wanted to grow their international operations, direct-to-consumer channels, as well as their menswear business. According to Neil, they're well on their way. But Jefferies analyst, one of them, actually came out, poured a bit of cold water, and said basically when it comes to those concerns in the marketplace, including higher inventory, which is something I know that you and I have spoken about in previous quarters, those still remain. So despite, executives saying on the conference call that that's going to be fine, we've got those air freight costs under control, and that's going to help us with margin expansion. Is that indeed the case? That is the question that some are asking. But despite that, I think in the times that we're in, this is a business that has been able to cement its reputation, to be able to avoid some of the concerns about a slump in demand. In fact, with such a strong brand overall, they're able to overcome them, and that could potentially be enough to make some of these supply chain chaos concerns go away. So we'll just have to wait and see. But clearly with the pre-market action almost 16% higher than many were anticipating today, I think they're going to be pretty strong when we get going in about an hour.
Thanks, Kamuta Ramanathan, for the update on Lululemon.
Okay, for sports fans, it's opening day for Major League Baseball, and there's also plenty of talk about artificial intelligence. Now, Major League Baseball is known for endless data and analytics. So how is it going to be married with artificial intelligence? Our next guest is an engineer who co-founded a company that builds intelligent pitching robots. And here's the scary thing, I think. It can replicate individual human pitches. There is no shortage of interest from MLB teams. We're joined by Joshua Pope, co-founder and CEO of Traject Sports. It's great to see you.
Thank you. Thanks for having me.
So this is a robot and it can pitch balls at the same speed as a professional?
Yeah, that's exactly right. So effectively, we take in-game data and we program our machine to replicate the precise trajectory. We pair that up with the pitcher's video, and batters before the game can face opponents before they step into the batter's box.
And you've got you're working with 13 baseball teams now?
Yeah, so 12 MLB teams and then one team out in Japan, which is great. And so we're kind of expanding the market from MLB internationally.
What is your business model? Do you sell them the machine or lease it, or how does that work?
It's a lease engagement, and we provide both the hardware and the license to the software. We maintain the product, and it's a multi-year lease engagement.
How did you get into this? What gave you this idea?
So in 2014, I think it was MLB that implemented TrackMan. And from the broadcasting data, you could actually visualize all these trajectories. And at that time, I was actually still in high school. And so my friends and I had a running joke, could we hit against the Toronto Blue Jays ace at the time, which was Marcus Stroman? How many swings would it take? And so we would see all these trajectories on the screen, and we would know that the data existed, but there was no physical machine to do that. And so one of the reasons why I went to the University of Waterloo and studied biomedical engineering was to actually go and accomplish that and build a machine that could replicate pitches so that, not just for fun for me and my friends, but also professional athletes could see the upside of getting in more reps before the game.
How fast, what's the maximum speed for a pitch?
We could throw up to 120 miles per hour, but we definitely recommend staying within the normal human range, which is like maxes out around 105 miles an hour.
So Clayton Kershaw of the Dodgers is one of the best pitchers currently in baseball, I believe. You can program it so it'll give you a Clayton Kershaw type pitch?
Yeah, and so we try to avoid the name and likeness of specific players, but effectively the teams have access to the MLB Stats API, which provides them player name and the trajectories, the full description of the speed, the 3D spin axis, the ball orientation, the release position. Our machine takes in any pitch trajectory, any of those coordinates, any of those variables, and interprets them and creates the precise replication to enact that. And so, for example, if you had Clayton Kershaw's data and you had access to it, you could use in-game video as well as pitch data collected by TrackMan, Hawkeye, that's readily available to these clubs and actually do the replication before the game.
And so it's for training and warm-up?
Yeah, so oftentimes it's for the batter. And so effectively, you're able to simulate who you're playing before the game. And so of our 20 or so products in the field today, 12 of them are at MLB stadiums. And so 8 of them, there's another use case at spring training to warm people up and et cetera. But yeah, that's effectively how it's used. And
so there's maybe we're looking at the footage right now. So you've got a video in front of the machine, and that will match the trajectory of the ball?
That's exactly right. Yeah. So the video shows you the wind-up. And the wind-up is, what the pitcher is doing before the delivery. And so you have the wind-up, you have the stretch, you have different timing cues with the leg kick. And that's all matched up with the exact time of release. And that's kind of what the batter gets to see. They don't have to worry about the data. They just hop in the box, and it feels like the opponent pitcher's right there in front of you.
You must have had the video game industry talking to you. I can see possible matches here.
For sure. Definitely right now, we are very busy, and it's the start of the MLB season, and so our focus is making sure that all the machines are up and running and are working well pre-game for our current clients. But beyond MLB, we're looking at collegiate, we're looking at international, and then possibly some gamification as well. Because of the augmented reality and gaming aspects kind of the product.
What about a machine that would replicate batters so that pitchers could learn to defeat different hitters?
Yeah, possibly one day. That would be pretty cool. Or just have a full AI game where it's, a robotic pitcher against a robotic batter. But I think what we really care about at Traject is finding what the upper bound of human performance is. And pitchers have had an edge for so long. They've had all this tracking technology. They've been able to dial in the 3D spin axis, the ball orientation, the speed, and figure out how these variables create more deceptive movement and even create new pitches. And finally, there's a technology for batters that we can actually combat kind of this incremental growth year over year. And so strikeouts have been increasing, batting average has been decreasing. And so the MLB actually has had an initiative around improving the product on the field, which includes offense. And so it's been really nice to create a technology for that
Because they want more scoring. It's more exciting.
Exactly.
Yeah. Home runs, or people love home runs, I suppose.
Yeah, the idea is like offense generates revenue because the fans come out. I mean, it is nice once in a while to see a perfect game, but it is also important to make sure that there is action on the field.
Are you able to identify any of the teams you're working with?
Our early adopter was the Chicago Cubs, and we have a press release on our website about that.
Okay.
But beyond that, teams see this as a competitive advantage, so we try to keep that close-knit.
Have you had a chance to talk to any of the baseball players yourself? Interact
so
with them?
Yeah. A few people on our team were down at spring training just a few weeks ago, and we visited 5 of our clubs out in Phoenix, the Phoenix area in Arizona. And we had a chance to speak with players who were leveraging our technology for different purposes. So you have a lot of the batters competing against each other head to head, who can hit a home run against a specific opponent. But we also saw use cases of player development. If I'm a high A baseball player, a double A or triple A player, how do I show my coaches that I'm ready to advance to the next level? And one of the ways to do that is in practice to overperform. And so we had a lot of players from academies and from the training facilities also eager to get in there to really show their talent.
Are you able to give us any kind of dollar figure on what your revenue is, or even how much you've raised so far?
Yeah. We're a Series A company. We're effectively still a startup, and we're 10 employees, and it's a low 6-figure lease value per year. The product's getting better over time, and with more traction, we're really excited about the future.
Amazing. Thank you very much indeed.
Appreciate it.
Because I want to bring in Mark Goldberg, who has been covering this industry for decades, longtime telecom consultant. Nice to see you, Mark, as always. And what was your reaction to the announcement today?
Frankly, my main reaction was it's about time. Many of the commitments that Rogers made were part of the original announcement 2 years ago. And I know you were just talking about what took so long for the minister. I think most of the things that the minister was able to reduce into contractual arrangement are things that the Competition Bureau should have done a year ago if they had had more imagination and less obstinance. They simply were not willing to consider any alternatives. And I think that's one of the reasons they got slapped down by both the Competition Tribunal and the federal court, and left it to the minister to negotiate this arrangement.
You know, Jared, I was thinking about it. It never seemed like an easy thing to want to do as the industry minister, to say, okay, we got a deal here, which is going to mean lower prices for all Canadians, because people generally feel skeptical about that. This is also coming, this announcement, in a week where we had a federal budget where there were flavors of affordability that were part of the dialogue. I mean, I didn't hear it asked by the media there, but I would have been curious to know, did you guys say, let's get through the federal budget first and then talk about affordability of phone service in this country afterwards?
And there's also the ongoing looming CRTC decision on wholesale rates offered to other internet service providers here in this country that I thought would be settled before Minister Champagne made this announcement on Rogers Shaw. But competition is clearly something that I think the industry minister wants to hang his hat on a legacy basis in terms of trying to establish that fourth carrier nationally. And it looks like from the conditions set aside here in this particular agreement, Videotron needs to have prices that are 20% less than what is currently established by the established 3 players here, Bell, TELUS, and Rogers, as well as
which isn't particularly an onerous requirement.
Yeah, more details on that, Mark?
Well, those kinds of prices are already in the market from the flanker brands, and there's a one-time benchmark. Keep in mind, in terms of the whole wholesale question, that really shouldn't have been thought of as something that the deal hinged on. The CRTC has other remedies. If you're referring to the tech-savvy application on undue preference, is Videotron getting a better deal than other people can get? First of all, you've got issues of scale, and the CRTC has remedies other than saying, no, you can't offer those prices. to Videotron. And at no time did even the Competition Bureau argue that the cable franchises were an issue. That and that's what the wholesale internet is based on. It's Shaw as a wireline company because Rogers and Shaw never competed. What we're going to see, though, from this deal is certainly increased competitiveness from, let's call it, the Freedom Mobile assets in Western Canada, because now you've got an owner that's willing to invest and in fact is committed by contract to invest in that Freedom network. And something that a lot of people simply haven't talked about is the impact on competition in Manitoba and Saskatchewan, that Rogers is a small wireless player there. Shaw was the cable company in those provinces, and now those provinces will be able to benefit from potential bundling by the new Rogers.
I guess one of the questions, and David, just to get you back into the conversation too, I made a point earlier of highlighting that you have seen some thinned out competitive ranks by some of the startups that we know there's so much focus on this fourth player today, but the fact that Cogeco acquired Oxio, our parent company had acquired Distributel and eBox, Quebecor itself had acquired VMedia, TELUS acquired Ultima, TELUS acquired Start.ca. So there is this thinning out question that's been playing out as we have literally been watching the play-by-play on Rogers and Shaw. And in the interim, you continue to see some concerns over things like, let's say roaming prices. I know sometimes we're talking about apples and oranges here, but the bottom line is there are a few players that control a lot of the industry.
Yeah, certainly. And I want to peg on that on one of the terms in the agreement signed by Rogers is the establishment of Indigenous owned and operated service providers. So we could certainly see the introduction of several smaller ISPs in Western Canada. But I also want to talk what Mark just said in terms of competition in Western Canada, where Shaw was an established player. We have heard from Rogers' CEO, Tony Staffieri, on the last earnings call, how there's potential revenue synergies. And revenue synergies is something that the company has yet to really expand upon. But that alone signaled to analysts that there's considerable opportunities for Rogers to expand and drive significant amounts of revenue, aside from the billion or so cost synergies that it's highlighted when it initially said to acquire Shaw Communications about 746 days ago. Now they see additional revenue synergies. This could be a significant boost for Rogers down the road. Seeing some of these penalties like $1 billion over the course of the 10 years, that's small potatoes compared to the opportunity that Rogers now has in front of itself.
David, Mark, thank you so much. Mark Goldberg, longtime telecom analyst, joining us, and our own David George Kosh.